everybody. I'm Stan, the Finance Man. And if you like this show, don't forget to subscribe to our channel and press the like button. Yeah, good. Thank you. Thank you very much. Depending on where you stand, this is either a nightmare or a dream come true for investors and traders participating in the stock market. A handful of stocks went through an unimaginable roller coaster ride over the last few days. Compared to Walmart, one of the world's largest companies, that went up by 3.67% over 3 months, Gamestop Corporation, a video game retailer, saw a gigantic jump of over 3,200%. It's blowing up a store. Now hold your horses before you go on with this entire shenanigans that Wall Street's gonna go down to the masses and Judgment Day is here and blah 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 blah. Here's what really happened, and here are the questions that we should be asking instead of coming up with these conspirators. Heavens to Betsy. A hedge fund is a pooled investment structure that may use long, short, or more aggressive strategies to make profits. Now that's out of the way, let me tell y'all what happened. Some big league Wall Street hedge fund managers, like this guy right here, believed certain stocks were too expensive and decided to bet on their downfall by selling them short. Now, short selling is an advanced strategy speculating on the decline of a stock, usually recommended only for experienced investors. Think there's something in my teeth. A sizable number of users on the subreddit group Wall Street Bets, which started in 2012 and grew to almost 5 million users today, decided to move against that very short bet. Slowly but surely, and in a concerted effort, the many Davids on the forum managed to go against the Wall Street Goliath and drive up prices. As prices go up, the big shots lose money by being on the wrong side of the trade. Remember, short selling is a bet on falling prices. So that guy, remember him, ain't too happy now. In addition, a reinforcing effect called short squeeze kicks in. Now, a short squeeze occurs when a stock price jumps sharply, forcing short sellers to buy it in order to avoid greater losses. Their scramble to buy puts further upward pressure on the stock price, particularly with those stocks that do not have a lot of trading volume, such as GME. On top of that, do not forget that all this is happening with leverage. Leverage is the use of borrowed capital in order to increase the exposure in an investment with the aim of multiplying the potential returns. Such trading with leverage in the market is pretty much equivalent to athletes using steroids, changing hands, even if only on paper, meaning the gains and losses are unrealized. Remember, when you invest in a stock, gains and losses only become real when the position is closed. Like restaurants during the quarantine. Lord only knows I miss me some cocktails at the local speakeasy. Now for the youngins who found this channel on the forums and don't know what speakeasies are, they were illicit drinking establishments back in the day when prohibition was in full effect.
Get that boat!
Canadian Club, Prohibition's favorite import, now available.
God love and bless the Canadians and the rye whiskey. Old-fashioned, the old-fashioned way. Back to GME and all that shenanigan. Now this roller coaster ride is thrusted forward by the force of many players and seemingly infinite transactions enabled by the rise of low-fee, or should I say free-of-charge trading platforms like Robinhood. Get it? Because he steals money from the rich and hands it out to the poor. Look, in the end, this is a zero-sum game, which means for every winner, there is a loser. Paired with the coronavirus and all these youngins sitting home cashing in the stimulus checks, putting it in their leverage accounts, looking to get rich faster than green grass passes through a goose. Who do we blame in this slippery slope of slimy bananas? The hedge fund managers and their greed, the cheap and highly leveraged trading platforms, the government for the stimulus checks, the virus that's spreading, the forums like Reddit, the internet as a whole, Bernie Sanders memes, the Russians and Putin? Well, I say neither. We shouldn't be asking who is at fault here. We should be asking, where do we go now? Is this bubble going to burst like Hubba Bubba cherry flavor all over our faces? And if so, will this happen sooner or later? Could this phenomenon spill over to even more stocks or other asset classes like cryptocurrencies? Is this so-called democratization of finance limited to members of a group, or is it accessible to the general public? Will fundamental research become superfluous given that the next star is born on a social media platform? Will hedge fund managers ride this very wave just with deeper pockets? What is and what should be the proper action by the SEC as a regulator? Will social dynamics and populism become a driving force in markets? Will short sellers go dark from now on? Is gambling, if you got a gambling problem, call this number. Is gambling becoming systematically ingrained in trading? Amid all these questions, one thing is for certain: some people will get burns in all this, particularly those who are late to the game and who bet all their net worth on a single risky trade. Without sounding righteous, these recent events do not fit the bill for investing. They fit the bill for gambling. Now that you know what was behind Redditgate, be sure to subscribe to our channel and press the like button. The like button. It only takes a second and it's free. And after you do that, go in the comment section and see if you can answer some of these questions and start a conversation. I'll be happy to hear your comments. This program was produced and put together by the team at Pension Bar. Got tension with pension? Pension Bar. Government pension. It easy.